Hello, and thank you for joining the My Solo 401k Financial Daily YouTube webinar. This is our second session of the day. We were live earlier. This is our second session. If you have questions or topics that you wish to discuss, please chat that over now so that we can be sure to get to them all. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So again, welcome to another session of the My Solo 401k Financial Daily Webinar and Q&A session. Today's topic is a good one. Today, we're here to discuss 2025 and 2026 Solo 401k contribution limits. Obviously, the ability to make contributions is one of the top reasons that customers set up a 401k. And the Solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. So this is a great topic, just another example of how we help you to stop overpaying taxes and start building real retirement wealth. Again, this is your chance to get answers. We go live every day, and we're here to answer your questions. So please don't hesitate to chat over questions now on today's topic or anything else. In the meantime, we'll just ask you to please like this video, whether you're watching us live, whether you're watching us on a recording, wherever you're watching us, whether you're watching us on YouTube, LinkedIn, X, Instagram. Please like this video. It's going to help your fellow solopreneurs. Why? Because it tells the algorithm that this content is valuable. So it'll help to amplify it, get the information out to other solopreneurs like you who might need it, who might be looking to catch up on their retirement savings. So again, please like this video. We also invite you to subscribe. That way you will get notifications of when we go live, of the content. You can come live and ask questions, or you can pin it for later. So please subscribe as well so you get notifications of all the content. Because as I mentioned, we go live every single day, oftentimes twice a day. So we're going to first dive into just spend a couple of minutes on some of the top Solo 401k benefits and features. So let's first start out with the foundation. A Solo 401k is for a self-employed individual with no non-owner, non-spouse, full-time W-2 employees working for any business owned by that person or a spouse, if any. That's what gets you in the game. Now, you've got different options. You could go with the basic vanilla Solo 401k, for example, at a discount brokerage like Fidelity, or you could go with an advanced Solo 401k plan like the one offered by my Solo 401k Financial. And even if you started out with the basic plan, like one that's offered by Fidelity or Schwab or Vanguard or E-Trade, you can always upgrade to our plan as long as you continue to be eligible. In other words, as long as you continue to be self-employed with no non-owner, non-spouse, full-time W-2 employees. Now, what are the advantages of setting up a Solo 401k with my Solo 401k Financial? Fast account setup and funding. For example, we prepare the documents, and that's what creates the plan is the documents, because a 401k plan is a legal entity. We prepare the documents within the same business day. Then we help you open up the accounts at the bank or brokerage of choice. So you're not stuck with just one institution, right? You can have your cake and eat it too. You can have the advanced features of our plan. You can have the advanced dedicated support of my Solo 401k Financial, but just still have your accounts at the bank or brokerage of choice, whether it's at Fidelity, Schwab, E-Trade, etc. And we'll help you open up and fund the account, oftentimes in as fast as one business day. Now, setting up a Solo 401k plan is going to allow you to make contributions. So those contributions could be pre-tax contributions that will reduce your taxable income now, or you can set up and make Roth contributions, mega backdoor Roth contributions. And just like any Roth account, it's going to have the potential for tax-free growth. In addition, if you already have pre-tax Solo 401k funds, or say pre-tax funds in a former employer plan or a non-Roth IRA, you can roll those over to the Solo 401k and then convert them as much or as little as you want year after year from a pre-tax status to a Roth status to further accumulate funds in your Roth Solo 401k account, where they'll have that potential for tax-free growth. Flexible contribution options, so you can diversify. You can do some pre-tax and then other Roth or mega backdoor Roth, or you can alternate year to year, pre-tax in one year, Roth and mega backdoor Roth in another year. So you can diversify from a tax perspective. You can catch up on your retirement savings. So a Solo 401k has the highest contribution limits for any defined contribution plan. And we're going to dive in, as I mentioned, to the 2025 and 2026 contribution limits here in a moment. But for example, at a high level for 2025, you can contribute up to $70,000 or more if you're age 50 or older. For 2026, $72,000 or more if you're age 50 or older. You can maximize your savings with our low-cost solo 401k plan. So even though we do charge a fee, we were the first solo 401k provider to offer a plan that qualifies for the tax credits. And now you see other providers that are rolling out their plan that qualifies for the tax credits. So we offered ours at the end of 2023. Now you see some that are other providers that are starting to come in and offer theirs almost over 2 years later, which is great because that helps to get the word out to solopreneurs, because this can be a powerful way to enable solopreneurs to be able to set up advanced solo 401k plans, because those tax credits are a dollar for dollar reduction in your tax liability, and $1,500 of tax credits is going to more than cover our fees for the first 7 years. We charge $650, which includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So it's a totally flat fee structure. For example, there's no asset under management fees. There's no transaction fees. That's going to cover all the ongoing compliance support, whether it's the 5500 EZ or the 1099R, if those apply. So you know exactly what you're signing up for. And even if you added up our fees over the first 7 years, it wouldn't even amount to $1,500. Our solo 401k customers can invest in what they want and what they know. So of course they can invest in traditional brokerage type investments such as stocks, bonds, mutual funds, FDIC insured certificates of deposit. But in addition, they have the option to diversify from an investment perspective in terms of real estate, private stock, crypto, precious metals, notes, pre-IPO stock, private placements, just to name a few. Easy to use. So again, we prepare the documents to establish the plan within the same business day. Then we'll help you open up the account at the bank or brokerage of choice. So one of the top brokerage options, for example, is Fidelity, where they have an online application process to open up the accounts at Fidelity. So customers are getting the plan documents from us, then they're opening up accounts at the bank or brokerage of choice. So if you choose Fidelity, now you can have payroll integration, because Fidelity has built payroll integration with some of the top providers like Gusto, ADP, Paychex. And then with that payroll integration, that's going to enable things such as automatic recurring contributions, automatic recurring 401k loan payments. Additional benefits include access to emergency funds, tax and penalty free. So what we mean by that is that our solo 401k plan allows for solo 401k participant loans. So that's where you can literally take money out of your solo 401k account. It's not going to be subject to taxes or penalties as long as it's documented as a solo 401k loan and within the solo 401k loan terms and paid back according to the required repayment schedule. So those terms are going to provide that you can borrow up to 50% of the balance, not to exceed $50,000. It needs to be paid back in monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1%, or it can be a CD rate plus 2%, with those payments spread over a 5-year term. Comprehensive solo 401k compliance support. And all of that's covered and included as part of our flat $125 annual fee. So what that support will entail will depend on what's going on with your solo 401k plan. So for example, all solo 401k plans will need to be updated as the law changes, right? 401ks are political footballs, so sometimes the law will change. Regardless, they'll need to be updated every 6 years. So those will sometimes require periodic document updates, but at least every 6 years, there will be a mandatory document update. So in contrast to other providers who may charge for that, and that every 6-year cycle mandatory plan update, we handle that for no additional charge for our customers. So we'll automatically handle mandatory plan updates and amendments. Now, other things that are required will depend on what's going on with the plan. So for example, if you do take advantage of the ability to take a solo 401k loan, that will need to be documented on loan documents. Now, we prepare those loan documents for no additional charge, but since we don't have access to the accounts, customers just simply need to request the documents. And we prepare those loan documents within 1 business day. We have an online form customers use to request it. Now, let's say you're making a mega backdoor Roth solo 401k contribution. Again, that's one of the top use cases. So that's a scenario that's going to require tax reporting, because when you make a mega backdoor Roth solo 401k contribution, it's a two-step process. The solo 401k owner first makes a voluntary after-tax contribution into a separate voluntary after-tax account, and then moves the funds from the voluntary after-tax account either to a Roth IRA or a Roth solo 401k. In either case, that subsequent move is going to be reportable on a 1099-R. So that would be a scenario where the customer would just go onto our website, submit the form to give us the information to let us know that they moved funds from the after-tax account to the Roth account. That's how we capture the information. The plan gets added to the queue to prepare the 1099-R. And again, that's handled for no additional charge. Form 5500EZ. So once the value of the plan, including the value of any defined benefit plan that might be sponsored by the solo 401k, exceeds $250,000, there will be an annual informational tax filing requirement. The name of that informational tax filing form is Form 5500EZ. So clients or their advisors just have to let us know once the value exceeds $250,000, then we'll add their plan to the queue to take them through that 5500EZ filing process, where we end up preparing the form under the electronic filing system to make it easy for the customer, advisors to get that 5500EZ filed. And again, for no additional charge. And then, of course, educational resources. So we have a wealth of information on our website. We have a community with over 32,000 members, right? These are solo 401k owners, advisors, just other interested parties. So it's totally free to join. All are welcome. With all those members, the largest community in the space, we have vibrant forums, we have a library of videos and webinars. So there's a ton of ways to learn and to share the knowledge. So we touched on a number of the features already. So, just to kind of really highlight the top ones, of course, the tax credit, the mega backdoor Roth, loans, alternative investments, the ongoing compliance support. We touched on eligibility, right? In order to be able to access these features, you do have to be eligible. So that's going to require that you're reporting earned self-employment income. There's really two elements you can think of. One is that you're reporting earned self-employment income. That's how you demonstrate that you're self-employed, and you have a lot of options. You don't have to have a formal legal entity, or you could have an LLC taxed as an S corp. Ultimately, you do need to report that earned self-employment income. So let's say your business is taxed as an S corp. The way that you would report earned self-employment income is W-2 wages from the S corp. Or let's say you're a sole proprietorship. You don't even have a formal legal entity. As long as you're reporting income on Schedule C of your 1040, that would be earned self-employment income. And then the other piece of the eligibility equation is that you cannot have any non-owner, non-spouse, full-time W-2 employees. So stated differently, you could have contractors working for you because those contractors are not W-2 employees. You could have a spouse working for you because there is a spousal exception. The spouse doesn't need to be an owner of the business. The spouse can be working as a W-2 employee, and that would not preclude you from being able to set up a solo 401k. You could have another owner of the business that's working in the business. As long as that individual is at least a 3% or more owner, then that would not preclude you from being able to set up a solo 401k. You just cannot have any non-owner, non-spouse, full-time W-2 employees. And just to really define it, full-time means that you're working at least 1,000 hours a year. I should say at least the W-2 employee is working at least 1,000 hours a year with a year of service, or 500 hours a year for 2 consecutive years. Okay, so that lays the foundation as far as eligibility, some of the top features and benefits. And so with that in mind, some of the top use cases would be the frugal investor. So again, setting up our plan is going to qualify the individual to claim $1,500 in solo 401k tax credits. So it's going to more than cover our fees for the first 7 years. The Roth maximizer. So setting up our plan is going to enable the individual to make not only your basic Roth contributions, but even mega backdoor Roth contributions, employer Roth contributions, in-plan Roth conversions. So there are now, because of Secure Act 2.0, which is going to require that certain solopreneurs who are over age 50, or I should say are 50 or older, and are making catch-up contributions, if they make more than $150,000 in W-2 wages, they will have to make those catch-up contributions as Roth contributions. So that now requires that even the big brokerages that are offering basic solo 401k plans are going to have to accommodate those Roth contributions. But that's as far as they go. Even though they do allow for some Roth contributions in terms of the employee contributions, whether it's catch up or employee, they're not going to allow for the mega backdoor Roth. They're not allowing for the employer Roth. They're not allowing for the in-plan Roth. So for those true Roth maximizers, they'll need a solo 401k plan like the one offered by my solo 401k financial that enables all those different ways to maximize your Roth account. The large account holder. So once the value exceeds $250,000, again, there is that informational filing requirement that's handled by my solo 401k for no additional charge. Customers, their advisors just have to let us know once the value exceeds $250,000. The alternative investor. So for those that really want to diversify into different types of investments, they'll need a plan like the one offered by my solo 401k financial that allows for those true alternative investments. The rainy day investor. So if you think that you might need to take a loan or you really want to take a loan, it could be to fund your business, could be for your own personal investment, it could be for any purpose whatsoever. You'll need a solo 401k plan like the one offered by my solo 401k financial that allows you to take a loan. All right, so that lays out some of the use cases. Now let's just stop. We'll field the question. We'll ask you again to please like this video as it helps us get the word out to other solopreneurs, other advisors like yourself. Then we'll dive into those 2025 and 2026 contribution limits. So if we deposited to a voluntary after-tax solo 401k with you, then roll that over to a Roth IRA at Schwab, who will get the 1099-R from, you or Schwab? Will it be email or postal mail? So we will handle the 1099-R for customers who submit the form on our website in a timely fashion. So you could still submit it now. If you go to my solo401k.net/forms here in January 2026, you could still submit it now, even for transactions that occurred in 2025, assuming that you signed, you started with us in 2025 or earlier. Now, going forward, timely means at the time of the transaction. So, for example, during 2026. But for now, you can still submit it. Again, my solo401k.net/forms. It's definitely not going to be Schwab, because even if that after-tax account is at Schwab or Fidelity or wherever the account is, they're just providing the holding account. So they don't police the account from a plan perspective. They're not handling the tax reporting from a plan perspective. And then we will file it, and then we'll email you a courtesy copy. Great question. All right, so now let's go to the contribution limits. So for 2025, and this is still pertinent, even though we're here in January 2026, because if you set up a solo 401k plan on or before December 31st, 2025, you can still make all types of contributions for 2025 by your 2025 business tax return deadline, including any timely filed extension. And you can see, based on the videos that are, for example, on our YouTube channel that we've been running the past few weeks, that even if you didn't set up a plan before the end of 2025, there's still options to set up a plan now here in 2026 and make 2025 contributions. For example, if your business is taxed as a sole proprietorship, you could still set up a plan and make all types of contributions. Now, you would have to make that employee contribution for 2025 by April 15th, but you could still make the other types of contributions by the extended tax return deadline if you filed an extension for your 1040. And then for other business types, like say you're an S corp, even though if you didn't set up a plan by the end of 2025 and your business is taxed as an S corp, then you wouldn't be able to make employee contributions for 2025. You could still make you could still make voluntary after-tax contributions. So the information is still definitely relevant, even for those who haven't even set up a plan or had not set up a plan by the end of December 31st, 2025. And then, of course, 2026 contribution limits. Now if you've got the income to justify it for 2026, you can start making those 2026 contributions. And then you'll have all the way up until your 2026 business tax return deadline, including any timely filed extension, to make all types of contributions for 2026 next year, as long as you set up a plan here in 2026. So when you think about those solo 401k contribution limits, as I stated, a solo 401k has the highest solo 401k contribution limits, or I should say contribution limits, for any defined contribution plan that's available to self-employed individuals. And why is that? Well, because a solo 401k is going to allow the solopreneur, the self-employed individual, to make not only employee contributions, but also employer contributions, even voluntary after-tax contributions, if they have a plan like the one offered by my solo 401k financial. So there's different buckets. So when thinking about the limits, it's important to recognize that there's the overall limit. So if you sum up all the contributions that are made to the solo 401k plan, those contributions cannot exceed the lesser of your self-employment income or the overall limit, because you can't save more than you earn. But then, as you'll see, there's also sublimits based on whether it's the employee versus the employer or the voluntary after tax. So in terms of the overall limit for 2025, the overall limit is $70,000. And then if you're age 50 or older, you can make a catch-up contribution of $7,500. Or if you're age 60 to 63, instead of $7,500, there's a super catch-up contribution limit of $11,250. Now for 2026, those limits increased. And that's because of inflation, right? Under the rules, the way that it works, if there's inflation, the argument is that you'll need to save more because you'll need more because there's inflation, costs have gone up. So for 2026, the overall limit increased to $72,000. The 50 or older catch-up contribution limit increased to $8,000. And then the super catch-up contribution limit remained at $11,250. So that's the overall limit. Now you've got the different sublimits. So let's assume, for discussion purposes, that the individual wants to make employee as well as employer, right? So what are the different limits? So in terms of the employee limit, you've got 23,500 for 2025, plus an additional $7,500 if you're age 50 or older, and then or 11,250 if you're eligible for the super catch-up because you're age 60 to 63 during 2025. For 2026, that employee limit increased from 23,500 to 24,500. The catch-up increased from 7,500 to 8,000 if you're age 50 plus. But the super catch-up, if you're age 60 to 63 during 2026, stayed the same at 11,250. And then the employer contribution limit, that's a percentage of your self-employment compensation. So the first employee limit, you can contribute 100% of your self-employment compensation, dollar for dollar, up to the applicable limit, right? For 2025, if you're age 50 plus, but you're not 60 to 63, that's 31,000. Just to give you an example. So 100% dollar for dollar of your self-employment income up to the limit. But if you're trying to make an employer contribution, it's a percentage of your self-employment compensation. So if your business is taxed as an S corp, your ability to contribute is based on the W-2 wages. That employer contribution limit is 25% of the W-2 wages. Now, if your business is taxed as a sole proprietorship or a partnership, you need to run a pre-calculation. And we've got a calculator on our website that'll run it. We'll help our customers we'll educate them. We educate every day on these contribution limits and how it applies to their situation. But you've got to run that pre-calculation. So if you're a sole prop, the pre-calculation is line 31 of Schedule C, so your net income less 1/2 of the self-employment tax. And then your ability to make an employer contribution is 20% of that self-employment compensation figure. If your business is taxed as a partnership, your pre-calculation is line 14 of the K1 that you receive from the business tax as a partnership, less 1/2 of self-employment tax. And then the employer contribution limit is 20%. So now it's important to recognize you still got to deal with the overall limit. So the sum of the employee, employer, and voluntary after tax cannot exceed the overall limit. So that's why we say, for example, let's assume the individual is under 50 for 2025. They have plenty of self-employment income, so they can contribute 23,500 as an employee. Then a percentage, let's assume that their business is taxed as an S corp, 25% of their W-2 wages. Let's assume that's 46,500. So the sum, right, the employee plus the employer can't exceed 70,000. So that's why they'd be capped at that 46,500. Now, the deadline to make these contributions is the business tax return deadline. So it's not necessarily your 1040, right? If your business is taxed as an S corp, it's going to be the S corp deadline, which is March 16th of 2026 for those 2025 contributions, or September 15th of 2026 if you file an extension for your 1120S. But if your business is taxed as a sole prop, then your business tax return deadline is really the 1040 deadline, because you report your earned self-employment income on the 1040 on Schedule C. So in that case, it's April 15th of 2026 or October 15th of 2026 if you file a timely extension. If your business is taxed as a partnership, it's the 1065 deadline, so March 16th or September 15th if you file a timely extension. If your business is taxed as a C corp, then it's April 15th of 2026 or October 15th. And then looking forward to next year, as long as you set up a plan on or before December 31st, 2026, you'll preserve the ability to make all types of contributions for 2026 by your 2026 business tax return deadline, including any timely filed extension. So it follows the same pattern for 2026. Okay, great. Well, we appreciate the chance to discuss these topics. Again, if this information is helping you feel more confident about your retirement future, your retirement savings, please like this video. It helps us to get the word out. Please like it on YouTube or Instagram, LinkedIn, X, wherever you're watching us from. We invite you to come to our webinars. So if you subscribe, you'll get the notifications. So we go live every day, bringing content. We also want to answer questions. So please always feel free to bring a question. We're happy to answer it, whether it's on the presented topic or anything else. We'll also invite you to our community. Again, the largest community of solo 401k owners, advisors around these solo 401k topics. So please feel free to join. You can join quickly and easily at mysolo401k.net/my community. It's free to join. All are welcome. All right, so now we're back to another question. Can the additional $8,000 catch-up contribution be deposited to the voluntary after-tax account? That's a wonderful question. It's a common question. The answer is no. So the voluntary after-tax solo 401k contribution limit is the overall limit. So you can contribute 100% dollar for dollar of your self-employment compensation as a voluntary after-tax contribution all the way up to the overall limit. So for example, $70,000 for 2025. Now that assumes that no other employee or employer contributions are made to the solo 401k, with the exception of the catch-up contributions. So if you're age 50 or older and you've got the self-employment income to justify it, and you haven't made that catch-up contribution to another plan, like say a day job 401k plan, then you can make that additional catch-up contribution, but it would not be made as an after-tax contribution. It would be made directly to either the pre-tax account or the Roth account. because really a catch-up contribution is a type of elective deferral. It's a type of employee contribution, which is either made as a pre-tax or a Roth, but it wouldn't count towards that after-tax limit. So if you only made the catch-up, you could still make the full, say, $70,000 contribution for 2025, assuming that you got the self-employment income to justify it, et cetera, et cetera. So you'll still be able to get to the same place, but you would say first put the catch-up contribution into the Roth account if your goal is to maximize Roth contributions, then make the full voluntary after-tax contribution to the after-tax account, then move it over to the Roth account. So you still, for example, for 2025, end up with 77,500, but you have to separate that catch-up and the after-tax. Wonderful question. All right, well, it looks like that takes us to the end of the questions for today. Thank you so much for investing your time with us. Your time is valuable, and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building the solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.